So we are after FOMC minutes, and what we can say for sure is that the outlook for upcoming year is getting more and more blurry. It's great to have you here, and I'm very pumped up that we will be able to go through this economic fire together. As who else could stifle this, I would say, district fire if not for us? So today we are continuing previous episode as that one has been interrupted. With the elements grabbed out of the transmission, we will get through another very important themes. So without any further ado, let's get to an intro. So, economy view is the subject that kicks off the episode. At first, let me find out whether everything works fine. You may put it up on the chat whether everything works fine. You may also write down what's up in your word out there, and you may share also your elements that you want to discuss in today's broadcast. So at first, let's have a look at economy view. And for this one, I'm sorry. Yes, we are starting off with FOMC minutes meeting. So we have right here depicted Fed's December dot plot. It hasn't changed obviously because we had just FOMC minutes. That's not related to interest rates change. That's why you may find out at first what's the objective for Fed. And in 2023, we can find that we will still hike interest rates even up to 5.5 in the most hawkish scenario. It's obviously everything data driven, but we need to assume that we will get around to 5.25 to the similar level when it was back during GFC in 2008, if my memory doesn't and serves me well. All right, so what happened during this FOMC minutes? Fed maintains that the inflation will stay above the course even during 2023, and they cannot go full throttle on interest rates as inflation looks deterring consumers. So governors intend on lowering inflation back toward 2% target at the risk of rising unemployment and slower growth. So 2% is somewhat very unreachable for now, and I would say that it would take longer than 1 year to get over there. We've studied some statistics that whenever the inflation gets out of 5%, it would take us even up to 5 years to get this down again. That's why the outlook, in my view, is not very optimistic. The main goal is so far out of reach, especially with this year. The composition of the voting committee changes quite significantly. It's been very hawkish already, and next year it's definitely going to be more dovish given likely interest rate expectations. So there is many of the Fed's members that shifting this year, and we are changing the committee to that extent that to get more dovish. But may it get us back to this even interest rate cuts this year? I'm not really sure about that. So that was the first very important topic. Right now we are switching to another BlackRock Halts withdrawals. That was the one of the subjects on today's Bloomberg's main site. So a little bit of introduction. During the GFC, property prices fell well below 5-year trend, and this was largely before the crisis peaked. Return to this trend alone would mean a further drop of almost 20%. And right now, could it have a repeat of that scenario? A great testimonial for problems on the housing market is what's happening with the BlackRock. And it's not the first time during last quarter when it halts withdrawals in UK. So UK's property market is in a, I would say, kind of a bigger trouble than its US, as it's a little bit smaller and have a little bit different structure. But what happens in the UK very often gets after in the US. So it's starting off with those, I would say, lower GDP economies, and right after spreading over those top-notched. So I'm talking about BlackRock, and yeah, that's exactly the company that everybody's fearing, saying they are going to own everything, and you're gonna rent everything. So we are seeing problems with it right now. But you may ask, what is the product? What is the product that right now is in a trouble? So it's about the braid. Braid is in order to specify this element. When the company invests in primarily stabilized commercial real estate properties with a focus on providing current income, that's called braid, and that's what we are talking about. So for this, they involved private individuals together with accredited investors that raised a bunch of money. So they, as it often happens, so they go out, collapse the market in housing, and buy up all homes and rent it back to you. And as many claim, that's their plan. So BlackRock is the buyer of last resort, and is the one of the powerful entity around. That's why many claim that it is gonna buy everything. It's and right after will rent you everything that it bought. So that's what's happening right now. BlackRock has suspended withdrawal requests from investors in its 3.5 billion pounds UK property fund, and BlackRock UK said in the past few days that it will defer redemption requests made at the end of September 2022 and due around now. So it looks like a rocky ride appeared to be on the horizon for Blackstone real estate income. Merely last month, inflows were slowing down and redemptions were rising. So as we can right now can find, pension funds are pulling out of their property holdings. They are typically smart money out there. When they see smoke, they know there's a fire, and real estate is going to be getting hit massively in the next quarters. They find during especially current circumstances where we are dealing with low liquidity environment. Right now, Blackstone halt with withdrawals, and that's what causing some speculation loop of possible insolvency. For now, selling commercial real estate in order to raise cash to pay out departing investors can take months if managers want to avoid fire sales. That's why the anxiety is that high. In In yesterday's episode, we've shown that housing market is highly leveraged and interest rates really hitting the sector. Moreover, yesterday's FOMC meeting seems Fed will not bow to current market circumstances and they won't ease their fiscal policy anytime soon. Fed officials noted that an unwarranted easing in financial conditions would complicate the committee's effort to restore price stability. Have you literally wondered what would it entail with it? There are many elements, but one of them is that the decline, of course, may bring some more problems to consumption elements where there are some um, statistics that show and projections that a fall in the US property prices from the peak by 30% could reduce consumption by around 4 basis points, and even GDP may lower down approximately 3 points. So it's kind of a very tired and very, very spooky outlook for the economy. For the investors, obviously, have you read the asset disclaimer yet? This investment in Braid involves a high degree of risk. Braid has been an outlier in terms of its overall performance when stacked up against other rates, but even if they recorded a high percentage net return against others, it doesn't mean it won't collapse. So you need to be ready for this. Always you can afford the securities if you are accepting a full loss of your investment. So that's why I wouldn't suggest everyone this product. All right, so it's another continuation of the housing market. CPI, in my opinion, will surprise this year, as recently we've seen, even if rental costs in the US are falling, the apartment list suggests 1% decline in November. We kind of find that in 2023, US Bureau of Labor Statistics revises the method of calculating the weight for the disability pension equivalent, which may lead to greater CPI volatility at the beginning of next year. So it may seems like CPI is going down, but we can find that the method of calculating the weight may change as well. So no matter what's the data, it's what matters is who counts the votes, as one of the anecdotes says. So costs related to rent and shelter were important factors in building a strong increase in core inflation recently, and exactly recent time shown some of the positivity in terms of lowering this down. However, most contracts, just bear in mind that most contracts are signed for a minimum of 12 months, and the rolling of contracts will still transfer the previous increases to inflation. So that's why CPI might be bumpy this year, and the volatility is something we need to deal with. Fed doesn't seem obsequious. Right now we can find there is a chart of liabilities and capital liabilities, deposits with F are banks other than reserve balance, and so on and so forth. And so what we have right here. So next year, United States will again face the problem of meeting the debt limit, which will most likely be raised again. When the value of the treasury account with the Fed increases, liquidity disappears from the market. Looking at past investigations into the debt limit, TGA, that is a Treasury Department's main account for tax revenues and other government expenditures, has fallen below 100 billion bucks. Similar situations can now be expected. We right now have hundreds, and that's where the debt limit has been found. We've been talking about this back in August and September of 2021 in one of our episodes. And withdrawals from the TGA represent a real increase in liquidity in private markets as the Treasury sorry Treasury releases frozen liquidity from its account. The limit is likely to be reached in 2023, which means that we should see additional liquidity in the markets in the coming weeks. On the other hand, just after raising the limit, dollar liquidity may collapse due to the rebuilding of funds for TGA and QT by the Fed. So we can find that liquidity should jump up right after this this another limit will be set. But for this one, we need another liquidity drawdown, and right after we would see another rally forward for hopefully in the second half of next year, as it's the most likely scenario. So we had back then in 2020, right after the COVID rally forward since 2021 February, we've seen slide and rebound in the beginning of 2022, and this self-fulfilling prophecy is about to hit the fan once again. So that's what it's like. Fed doesn't seem obsequious right now to current circumstances, and will drain their budget even further. So it can be seen that the level of reserves in and this is very important for the behavior of SPX in the last 2 to 3 years. If the money from the TGA goes to the private market, the S&P 500 may be guaranteed to move above even 4,000 points, and even higher if there is a reduction in the amount of reserve repo carried out. On the other hand, we expect liquidity may be drastically reduced when a new debt limit is set. So that was about Fed's balance and its impact on the SPX performance. Right here you can find a spooky outlook for inflation. Inflation projections in the US have been significantly raised, and more importantly, inflation won't reach the target in the forecast period. Currently, the median for 2023 assumes 5.1%. It's worth noting that's an assessment at the end of the year. Before this time, rates may rise higher so that they can be lowered at the end of the year. Therefore, an increase to 5.5 or 5.75%, and a reduction to 5% cannot be ruled out. So it's still far out of reach. And market outlook, that's the element we've stopped our transmissions yesterday. That's why I will go through the most important elements with you right now. So what I meant, right here we have DXY, and DXY shows us that we have built a power for next upcoming growth. We can find that some of a rectangle box has been built right here. Rectangle bottom, if you also says so. So DXY is the one that supposed to play its first role in the first months of 2023. We still have the area of uncharted territory of 109 to test out, as we haven't tested them from the bottom. That's why DXY may threaten many risk focused traders and investors. So also RSI looks quite positively. We are rebounding out of this triangle that this time has used and served as a bottomed formation. We still need a firm rebound on a daily candle out of this rectangle to validate the structure. But it's high. That's the one of a pattern that's supposed to be broken to the upside. Okay, and we are getting back to market outlook and talking about downgrades. So with DXY rise, I do expect we will drop on major indexes. For instance, there is a US 100 that's right now teetering around this current levels of the support, and it would take time to break lower, but there are more and more facts that favor that scenario. So as analysts cut earnings forecasts into and during the recession, equities bottom sometime during the recession. Since the S&P 500 is over 3,800 right now, we should see it slipping in the first half of the year and through the beginning of a second half recession before it finds its footing, perhaps later this year. So more pain in 2023 is possibly yet to be seen, but my optimism about the economy means we are now building the base for solid gains, not just in bonds, but equities, even high beta ones, and even in crypto. And these earnings are somewhat difficult to tackle, but that's something what we've expected. And have a look at Amazon that slashed more than 18,000 jobs in escalation of cuts. So that's what we have also expected right now comes true. So right now we are going through historical layoffs among full technological sector. So we still have room for drawdown for major, I would say, Wall Street's behemoths. So that's for this one. Right now, let's get back to our market outlook. Unreachable objectives is the one that right now are looking towards PE ratios. So the price to earnings ratio is a valuation metric that gives a general idea of how company's stock is priced in comparison to the earnings per share. And market is still pricing in an increase in the average profit for companies from S&P 500 salvage current resistance stands for scenario when the Fed must cut rates and end QE. So we have remarkable positioning favoring hedges to the downside about the environment and it's not supporting growth yet. The only answer is right now a sideways movement that may put investors into a lull and prolonging necessity covering expenses of maintaining position that as a consequence may eventually lead to closing their positions in the short-term period. Clear out some of the order book and given the room for bears to step in at this micro uncharted territory. So right now the base scenario is sideways right after. I would expect this one to draw down. Crypto outlook. Let's have a look what's out there. Declines recently on the volume have been exaggerated by general exodus of active retail participation as well as the fear of other potential negative catalysts that could still rattle the industry. Low valuations and damaged balance sheets will mean the continued prioritization of credit risk over market opportunity. And as a result, the market will demand a safer alternative to the current stock of unregulated offshore exchanges performing dual functions of custody and matching. In terms of regulatory, as many of investors are really aware of it, yet an upcoming use case of US regulatory, hopefully friendly environment for crypto is to grab capital out of China, Russia, Venezuela, other financially repressive countries. So I do expect US won't be that stupid. And encouraging foreigners is the one reason for the US to support rather than undercut the current crypto ecosystem. So United States should remain the refuge of freedom. But leaving aside regulatory issues in terms of growth for the sector, we need fresh blood that will become a grist to the mill for future growth. That's why it would still take time, especially with this unprecedented recent year that was the first in the history of Bitcoin, second consecutive year of drawdown. So it looks like we are dealing with a environment of diminishing returns on Bitcoin, and what worked in the past may not work in the future. That's why you need to be aware. You need to be aware. Market movers. What's inside of this element? So, economic calendar, as always, is the one of the most important elements in the market that we need to have a track and keep an eye on. Let's jump to this week, and we went through Wednesday yesterday as there was PMIs at 48.4. That's the gauge that showing us the power among the economy. And right now, as is expected, after that strong spike, we are sliding downward. So this spike couldn't be maintained. We have rejected it very quickly. And as always on the market, we need to take cautious when such rejection happens. Let me take a sip. All right. So PMIs right now are not optimistic in terms of longer spectrum of an economy, and right now we are heading back to the levels been recently seen at the beginning of 2020, and I wouldn't expect a V-shaped recovery. We would need some more time for this to tackle. And what lies ahead? We have already delivered initial jobless claims that's lower than the previous elements. So jobless claims right now showing that the labor market is in strength, and we have global composite PMI final today at quarter to 10 a.m. And on Friday we have inflation rate out of the EA and non-farm payrolls of US. That's also worth watching, and that may shake the market for some time. Okay, so what we have right of next? As next, let's trade idea, and for me, let's have a look at some of the interesting charts. So we are jumping to WTI USD. That's right now showing us that so WTI USD right now showing kind of a return to the previously met support, and that's why I do find it interesting. So WTI, in my view, could return back to the area of 76.8, but it's kind of a tricky, as the 76.8 has been recently tested once by bulls, and right after hasn't been tested back in right here, and it may be taken another time. So for me, basis scenario is if we manage to keep up and rebound out of this area, the WTI USD should get us back to 76.8, and it's around 5.4% of growth. So it means if you like to, it looks like it probably won't as we can find right now, this support is breaking through, so it means it's more likely to go downside than upside. So we have just rebounding out of this recent test on 74.7. So it means that this level of support won't be tested from the upside, at least from the downside, at least for now. So WTI is eventually crashing, and my thoughts for now, as I have expected this one to rebound out of this area, my thoughts won't get have its scenario. So I would wait for WTI to rebound more fiercely from the area of 71.2, and it may happen anytime soon. So this area is the one where I would watch a WTI very carefully in terms of possible growth scenario. So if it managed to build some of a pivotal structure around this level, I would expect this to trade like Let me find out. So from here will be a long position. Even better, if we get up to 70.6, we would see such of a possible trade that will stop at previous highs at 74.7 with a stop loss around 69.6 with risk reward ratio at 5.1. But for this one, we need still hang on, as the price action I would need to stop around this level. So in order to take such position, just have a track of Blockrevision, as I will update you about the issue. So if you haven't subscribed, you may do it right now. So also, if you haven't noticed, you may comment on the chat going live about the elements that interest you the most. So about any suggestions, about any elements that nagging you, I will get back to them as soon as possible. Thank you very much for today's episode. If you enjoyed, just drop a like for statistics and for bit of an engagement. And thank you very much, and see you tomorrow at 8:45 a.m.